Welcome to the Data Dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. We're back with what definitely feels like an emergency update today.
Yeah, things move pretty quick.
Right. Diving straight into something that, well, it grabbed a lot of attention just within a few hours, a really rapid upward price swing in Bitcoin.
Mm-hmm.
You likely saw it happen, maybe watched it unfold in real time, or, saw the headlines just shouting about it. It was fast, it was significant, and it certainly got people talking.
It absolutely did. That kind of quick, sharp move, it always makes waves in the market. It affects a lot of different players,
Yeah.
especially those using leverage. Our job is to sort of peel back the layers of that rapid swing. We want to get beyond just the headlines and that feeling of sudden movement and really unpack the underlying data,
Right.
understand the mechanics, what was really going on, and crucially, what wasn't changing beneath the surface during that short period.
Okay, let's do it. Let's unpack this. The first piece of data you sent over, it feels absolutely crucial for understanding the mechanics of these rapid price moves, right? Especially the ones tied to speculation and leverage. The BTC Liquidation Heatmap.
That's the one.
Just hearing liquidation heat map, I mean, it sounds intense. What are we actually visualizing with this tool? What is it showing us?
So the liquidation heat map, as your source material explains it, it's going to be a visualization tool. What it does is aggregate margin call data or, liquidation data.
Okay.
And this isn't just looking at one exchange or one type of trader. It kind of pools data from multiple exchanges and various levels of leverage that traders might be using.
Right, different risk levels.
Exactly. The main goal is to visually highlight specific price levels where there's a significant concentration of these leverage positions that are set to be forcefully closed out if the price actually hits those points.
Got it. So those horizontal bands across the chart we're looking at, they represent the different price levels.
Correct.
And the color of those bands tells us the intensity, like how many potential liquidations are clustered at that price.
Exactly right. The color scale, it typically runs from shades of purple, which means low concentration, all the way up to bright yellow for the highest concentration. That tells you the relative density of these predicted liquidation points.
Relative density, okay.
Yeah, think of the yellow zones as like potential pressure cooker points in the market. Areas where a large number of traders using leverage are going to hit their margin limits pretty much simultaneously if the price moves into that zone.
And when these leverage positions are forcefully closed, what does that actually mean in terms of like market orders hitting the book?
Great question, because that's really where the cascading effect comes in. It's key.
Right.
So if you're a trader, holding a leveraged long position, you're betting the price will go up and the price drops down to your liquidation level, well, the exchange automatically sells your Bitcoin. They have to close the position and recover the funds they lent you.
Okay, forced selling adds sell pressure.
Exactly. And conversely, if you're holding a leveraged short position, betting the price will go down and the price actually rises up to your liquidation level, the exchange automatically buys Bitcoin to close out your position.
Which adds buying pressure.
Bingo. Forced buying adds buying pressure.
Ah, okay. So hitting one of those dense yellow bands above the current price triggers a wave of, well, forced buying from all those short positions getting liquidated.
Precisely.
And that forced buying just adds fuel to the fire, adds momentum to the upward move.
Precisely.
Yeah.
And, the same thing happens in reverse for moves downwards into dense, long liquidation zones. Forced selling pushes it down faster. This leads us straight into how traders actually use this map, like the source details.
Okay. How do they use it?
Well, first, they use it to spot what people often call magnet areas. These are price levels, particularly those dense yellow zones, where the price might actually be drawn towards.
Why a magnet?
Because triggering liquidations there doesn't just close positions. The forced market orders needed to close them act like fuel, right? So hitting a dense short liquidation zone creates this pool of mandatory buying. That can accelerate the price upwards, maybe towards the next cluster of shorts, creating a cascade or, a chain reaction.
Huh. It's kind of like the market has laid out these speed bumps or maybe launch pads for itself, just based on where people have placed their leveraged bets.
That's a very good way to put it, yeah. Launchpads and speed bumps. The second key use, according to the source, is identifying latent support or resistance zones. So even before liquidations actually hit, levels that have concentrated potential liquidations often sit alongside areas where maybe large players have placed significant orders anyway. So these areas with high liquidity, whether it's from pending liquidations or just big limit orders, they can sometimes allow for really swift large entries or exits, and potentially even reverse the price flow, though, the heat map itself is primarily showing the liquidation potential, not the limit orders.
Got it. But there's a crucial caveat here, isn't there? The source is pretty clear. This map forecasts where liquidations might begin, but not necessarily where they'll end. Like a cascade could blow right through multiple levels.
Absolutely, that's critical. And also critical, the density is best interpreted relatively. That brightest yellow zone, it's the most concentrated on that specific map at that specific time compared to the other levels on that same map. It's always just a snapshot of potential pressure points.
Right, a snapshot in time. Okay, let's apply this directly to the event we're talking about, this rapid upward swing. Before it happened, you had a snapshot of the liquidation picture from earlier. What did that previous heat map tell us?
Yeah, looking back at the previous data you provided, the total potential magnitude of liquidations shown on that earlier map was, well, it was significant. It was around $182.85 million.
Wow, okay.
And we specifically noted some pretty prominent yellow zones indicating that high concentration. Those zones were definitely building up noticeably around the $106,000 level. They were extending upwards through $108,000. And significant clusters were appearing up in the $110,000 area, possibly even pushing higher, maybe towards $112,000.
Right. Those were the potential battlegrounds. We identified areas where leveraged positions were just clustered, making them kind of ripe for volatility if the price reached them.
Exactly. They represented these pools of liquidity and potential forced orders just waiting to be tested by a price move. Okay, now let's look at the current liquidation heat map image you provided, the one captured after this rapid swing happened over the last few hours.
Okay, and just looking at the headline figure on this new map,
Huh?
wow. The total potential magnitude has jumped considerably. It's now showing $216.27 million in liquidations.
Yeah.
That's an increase of, what, over $33 million in potential forced closures compared to the snapshot from just a bit earlier.
It's a non-trivial increase, absolutely. Shows more leverage potentially in play or maybe positions shifted. Now, let's look closely at the specific price levels on this current map, where the dense yellow bands are located. Now, are they still concentrated around those same earlier levels?
Looking at it, yeah, it seems like it. We can clearly see very thick, dense yellow bands persistently sitting right around that $106,000 level still. The density definitely extends upwards through the $108,000 zone, and there is still significant concentration reaching up towards, and yeah, past $110,000. Visually, it looks like this density is pushing higher, similar to before, but maybe with some shifts after the move, reaching levels like $112,000, maybe even extending towards $114,000 and higher up.
Right. So it seems the upward move likely did clear out some of those short positions that were sitting below where the price ended up.
Yeah, makes sense.
But the dense zones above the starting point were definitely hit, triggering those cascades we talked about. And perhaps, new leverage has entered, or maybe surviving positions have sort of reinforced the densities higher up. The visual distribution, the landscape of density has certainly been impacted by the price movement itself.
Okay. So that's the key takeaway from comparing the two maps for this specific event then. The shift in where the high density zones are, plus the increase in the total value vulnerable, it shows the market reacting in real time.
Exactly. The price moved up. It hit those short liquidation zones above its starting point. That triggered the forced buying, which, well, propelled the price higher. And now it's left behind a new landscape of potential liquidation points for the market to navigate.
So, okay, connecting the dots directly back to the rapid upward price swing, how does this heat map data explain the speed and the magnitude of the move we just saw? It felt really fast.
It's that feedback loop we discussed. It's crucial for the speed. As the price began its climb, right, it inevitably started hitting those concentrated density zones above where it started those yellow bands building up from 106K through 108K and toward $110 and higher.
Right, magnets.
When the price hits these levels, it triggers cascades of short liquidations. And remember, liquidating a short position requires buying Bitcoin on the market to close it out. So when you have millions and millions of dollars worth of short positions all clustered at a specific price, hitting that level just unleashes a flood of mandatory buy orders.
And that sudden surge of buying pressure just slams into the exchange order book all at once, basically?
Exactly. And this forced buying, it's not like organic demand where someone decides they want to buy. No, it's positions being closed involuntarily. It acts as incredibly powerful concentrated fuel for the price move.
Okay.
It accelerates the price increase significantly, pushing it faster and often higher than it might have moved based purely on, discretionary buying and selling. This creates that feedback loop. Price hits a zone, triggers buys, price accelerates, hits the next zone, triggers more buys, accelerating even further. This is like a primary mechanism by which leverage amplifies relatively small initial moves into these really rapid swings we see.
So the map essentially showed us the potential energy that was just sitting there waiting to be released. And the price moving into those zones was the trigger that released it.
That's precisely right. That's a great analogy. Understanding these levels, these concentrated zones on the liquidation heat map is incredibly crucial for you, the listener, if you're trying to interpret these short-term market movements.
Yeah, makes a lot more sense now.
It shows you where significant pressure points exist in the market, simply due to the structure of leveraged positions. These aren't just arbitrary lines in a chart. They're levels where the market structure itself can amplify volatility, making them prime candidates for swift and sometimes dramatic price action if they get breached. It helps explain how a relatively modest initial push can suddenly become a rapid swing.
That is fascinating. It really gives insight into the mechanics of market volatility, especially driven by leverage. It shows one layer, a very active layer of what was happening.
Right.
But as you mentioned earlier, to be truly well-informed, we probably need to look beyond just the surface, right? Beyond the immediate price action and these liquidation cascades, and examine the fundamental state of the network itself. What's going on deeper down?
Absolutely. And that brings us perfectly to the second set of sources you provided, those Clark Moody Bitcoin dashboard images.
Hey, the dashboard.
Yeah, think of the heat map as looking at the choppy waves and the currents right on the surface, driven by market participants and leverage. The dashboard, though, it's like looking at the depths of the ocean, right? The underlying geological structure, the things that change much more slowly and really define the environment over the long term.
Gotcha. Deeper currents versus surface waves.
Exactly. So we have two snapshots from this dashboard, one from our previous discussion, which gives us a baseline, and a very recent one, captured pretty close in time to this rapid price swing. Comparing them lets us see what, if anything fundamental, actually shifted during the hours this rapid move occurred.
Okay, let's dive into these dashboard metrics then. Starting with the figures maybe most closely tied to price, at least at first glance, price and market cap. What do the two snapshots show?
Okay, so from the latest dashboard image, the price is listed at $109,100. And the market capitalization is shown as $2.16 trillion.
Okay, 109.1K and 2.16T. What about the previous one?
If we compare that to the previous snapshot, which was taken before the most dramatic part of this move, the price was $108,740. And the market cap was also listed as $2.16 trillion.
Hold on. So on the dashboard, over the period that included this rapid swing and all that liquidation activity you just talked about, the reported price moved just, $360? From $108,740 to $109,100.
That's right.
And the market cap value just remains static at $2.16 trillion.
Correct, according to these snapshots. So while the price movement itself felt dramatic, in percentage terms relative to where it started in that short window, likely amplified by those leverage cascades we saw in the heat map, when you look at the dashboard summary figures covering that specific time frame, the absolute change in the reported price and market cap appears quite minimal.
Wow, that immediately creates a really stark contrast, doesn't it, between the feeling of a rapid swing in the market and the fundamental statistics shown on the network dashboard covering the same period.
It really does. It's a key distinction.
Okay, that's super important. Let's move to what many people see as like the heart of Bitcoin's verifiable security and robustness, the network metrics, specifically difficulty and hash rate. What do the dashboards tell us about these during this swing?
In the latest image, the difficulty is listed at a just staggering 108.37 million, and the hash rate is 956.9 exahashes per second, EHs.
Okay, huge numbers. What about the previous snapshot?
Now, look back at the previous snapshot. The values were exactly the same. 108.37 million difficulty and 956.9 EHs hash rate.
Wait, completely unchanged. Seriously, despite the, multi-million-dollar liquidation event and the price swinging around like that.
Fundamentally unchanged during that window, according to these snapshots. And this is profoundly significant. The hash rate, remember, represents the total computational power being directed towards mining and securing the Bitcoin network at any given moment. 956.9 exahashes per second is, it's an almost incomprehensibly large number. An exahash is 10 to the power of 18 hashes every second. That number signifies a network secured by an absolutely massive amount of dedicated hardware, ASICs, and the electrical power needed to run them.
Yeah, it really underscores just how incredibly expensive and difficult it would be for any single entity to muster enough computing power to actually attack the network, doesn't it?
Prohibitively so for any sustained attack. Commanding a majority, 51% of that hash rate for any significant period, is just economically unfeasible for any known actor today.
Yeah.
The stability of this metric, staying pegged at such a colossal level, especially during a period of market turbulence like this, it really highlights the network's underlying strength and resilience. It shows that the miners, the actual physical infrastructure securing the network, were just operating consistently, completely unaffected by the price noise on the exchanges.
Okay. And the difficulty, that 108.37 million figure, what does its stability tell us?
So, difficulty is an automatic adjustment that's built right into the Bitcoin protocol itself. It adjusts about every 2 weeks, or more precisely, every 2016 blocks. And it adjusts based on the total hash rate that was observed during the previous 2016 block period. Its sole purpose is to ensure that, on average, a new block is found roughly every 10 minutes. That's the target, regardless of how much or how little hash rate is actually on the network at the time.
So more hash rate comes online, difficulty goes up to keep blocks at 10 minutes, hash rate drops off, difficulty goes down.
Exactly. Higher hash rate leads to higher difficulty, makes it harder to find blocks, keeps the 10-minute target. Lower hash rate, lower difficulty, easier to find blocks, again, maintains the target.
So the difficulty being stable here means the network is successfully maintaining its target block time because the overall hash rate has been stable leading up to this point.
Precisely. It reflects the stability of the hash rate over the relevant adjustment period. And the dashboard also shows the projected difficulty retarget date, which is still showing June 13, 2025, with a predicted small decrease of an extra 3%. This projection, too, remained unchanged between the snapshots.
Okay.
This means the network's built-in automated adjustment mechanism, which is purely based on observed hash rate over the past couple of thousand blocks, is just operating exactly as designed. It's completely unfazed by a rapid price move that unfolded over mere hours. It doesn't care about the price.
It's actually incredible when you think about it. This sophisticated global network securing literally trillions of dollars in value is just chugging along, adding blocks predictably, while the market on the exchanges is having what feels like a really dramatic, significant moment.
It speaks volumes about the genius of the protocol's design and its inherent resilience. Let's look at the supply side next. This is, one of Bitcoin's most fundamental and unique properties.
Right, the hard cap, the halvings, stuff that doesn't change.
Correct. And the data confirms it. Both the previous and the current dashboards show the total supply at 19.876 million BTC. And the percentage issued at 96.64%.
Also completely unchanged between the two snapshots.
Also unchanged,
Right.
as it must be, right? It's dictated by the code. Bitcoin's fundamental scarcity, that absolute hard limit of 21 million coins that will ever be mined, and the predictable halving issuance schedule that reduces the rate of new coins being created by half roughly every 4 years.
Yeah.
These are core, immutable properties of the protocol.
Yeah.
They are not, and they literally cannot be, affected by short-term price movements or any amount of trading activity on exchanges. The vast majority of Bitcoin that will ever exist is already mined and out there, and that simple fact is completely independent of the price action we just saw.
Okay. And what about the stock-to-flow metrics, those models that try to link scarcity to value?
Yep, those are on the dashboard too. The realized stock-to-flow is listed at 119, and the forward stock-to-flow is at 113. And again, same values in both snapshots.
Stable.
Perfectly stable. These values, which are basically derived from the existing supply, the stock, and the rate of new supply issuance, the flow, also remain constant, which reinforces, at least by this model's framework, that the underlying scarcity dynamics haven't changed one bit, regardless of the daily price gyrations.
Okay, good context. Let's look at layer 2 activity, the Lightning Network. That's designed for faster, smaller transactions off the main chain, right?
Okay.
How did that fare during the swing?
Right, so the latest dashboard shows the Lightning Network total capacity, that's the total amount of Bitcoin, locked in public payment channels at 4,089.71 DTC. And the total number of channels is listed as 3,738.
Okay, and the previous snapshot?
The previous snapshot showed capacity at 4,085 BTC and channels at 3,737.
So, okay, over the entire period of this rapid swing, the Lightning Network saw a gain of about 4.7 Bitcoin in public capacity, and exactly one additional channel opened.
Yeah, a marginal, almost imperceptible increase when you consider the overall scale, right? This data point is important, though, because it shows that the Lightning Network, which is definitely key to future scaling for certain types of transactions, is indeed seeing slow, steady, incremental growth. It is growing.
Okay.
But, crucially, this tiny, stable growth is clearly not correlated with, nor was it driven by, the rapid dramatic price swing that just happened on the main market. It's just incremental progress happening totally independently of the market frenzy.
Right, two different things happening at different paces. Okay, and finally, the reachable nodes. These are the decentralized computers all over the world running the Bitcoin software, right? Verifying every transaction, every block.
Exactly, the backbone of decentralization. And both dashboards show the number of reachable Bitcoin nodes holding steady at 22,035.
Okay, same number. What about Tor nodes?
The percentage of Tor nodes, those are nodes using the Tor anonymity network to make their location harder to trace, changed only minimally. It went from 65.28% previously down slightly to 65.14% in the latest snapshot. Tiny fluctuation.
So basically, a static total node count and barely any change in the percentage using Tor for privacy.
Correct. And this just reinforces the stability and the robustly decentralized nature of the verification layer. Having a high and stable node count distributed all over the globe is absolutely critical because each of these nodes independently downloads and verifies the entire Bitcoin blockchain. They enforce the rules of the protocol themselves. They don't rely on any central authority, any company, any government to tell them what the valid chain is or what valid transactions look like.
They are the distributed auditors, essentially, keeping the whole system honest and running according to the rules.
Exactly. This resilience against censorship, against single points of failure, it's fundamental to Bitcoin's whole value proposition, right?
Yeah.
As an immutable ledger, as a form of money outside of traditional control structures. The static number of reachable nodes here and the minimal change in Tor usage, it shows that even during a period of significant market volatility on exchanges, the core network verification layer remained robust, decentralized, and completely unaffected in its day-to-day operation.
Okay, wow. We've walked through all these key metrics from the dashboards: price, market cap, hash rate, difficulty supply, stock to flow, lightning network, nodes. Almost every single one showed absolute stability or only the slowest, most marginal predictable growth during this rapid market move. They were just operating exactly as designed, totally independent of the price action.
Yep.
But there's one specific data point that precisely links the timing of this market event, this rapid swing, back to the network's own clock, its own progress. You mentioned it earlier.
That's the block height, yes. The previous dashboard image you shared shows a block height of 895,980.
Okay, 895,980. And the current one.
The current dashboard image taken after the swing shows a block height of 896,104.
Okay, let me just... 896,104 minus 895,980 equals 124. Just 124.
Precisely, 124 blocks. The rapid price swing upwards, the one that triggered potentially hundreds of millions in liquidations if you look at the current map, the one that generated all those headlines about quick market movements, it occurred over the production of only 124 blocks on the Bitcoin blockchain.
Wow. And given that blocks are produced roughly every 10 minutes, 124 blocks is a period of network time equivalent to just over 20 hours, like less than a day of network operation.
Just in a day of network time, yeah.
That number, 124 blocks, it puts the entire time frame of this rapid swing into such crystal clear perspective based on the network's own undeniable, verifiable progress. It wasn't an event that unfolded over days or weeks or even many hours of wall clock time in terms of the network's actual work. It was merely the time it took for the network to find and add 124 blocks to the chain.
And that is a key, verifiable piece of data. When we start to synthesize everything we've looked at, it directly links the duration of this volatile, surface-level market event to the underlying network's steady, predictable, block-by-block operation.
Okay, this is where it gets really interesting, right? Pulling together the two halves of our deep dive today. On one side, we have the surface level chaos and excitement, the rapid price swing, the millions in potential liquidations stacking up on the heat map, acting as an accelerator for that move, highlighting the huge impact of leveraged trading and market structure dynamics.
Yep, the market trauma. And on the other side, derived directly from that dashboard data, we have the underlying fundamental reality of the Bitcoin network itself. The stable, absolutely immense hash rate securing the network, the stable difficulty ensuring those predictable block times, the fixed and totally unchanging supply schedule, the static and robustly decentralized node count verifying everything, and the barely perceptible slow growth on layer 2 like lightning.
And all of this fundamental stability happened over a period corresponding to the addition of just 124 blocks.
Just 124 blocks.
It's such a stark data-driven contrast, isn't it? The sheer drama and speed of the short-term price move, amplified like crazy by market dynamics and leverage, unfolded over a time equivalent to adding barely over 100 blocks. Meanwhile, the core metrics that describe the network's actual function and its long-term characteristics remained largely immutable or just showed their usual slow, predictable pace of change. It really highlights the fundamental difference between market headlines and, well, network reality.
Absolutely. While those rapid price movements, driven by speculation, by leverage, by the triggering of those liquidation clusters we saw, while they generate all the immediate excitement, dominate the news cycles, and become the entire focus for short-term traders.
The underlying verifiable health, the security, the ongoing growth of the Bitcoin network, as measured by those core dashboard metrics, the hash rate, the difficulty, the supply schedule, the number of nodes remain largely static or showed only marginal, slow, predictable growth during this exact same period. They just kept operating precisely as designed, totally independent of the emotional and speculative roller coaster happening on the exchanges.
And this brings us to a really crucial point about what has truly driven Bitcoin's remarkable historical growth,
Yeah.
right? Its price appreciation over the past decade plus. When you zoom out and look at its trajectory since inception, is it really driven by the daily noise and these rapid swings? Or is it something more fundamental, something deeper?
Yeah, fundamentally, it has to be the latter, right? The long-term growth, the staggering increase in valuation we've seen with Bitcoin over the years, it's driven by the steady, verifiable properties of the network itself. It's that fixed and auditable supply schedule, enforced by the code and the halvings, creating that undeniable digital scarcity. It's the ever-increasing hash rate securing the network, making it exponentially more secure and vastly more expensive to attack over time. It's the decentralized and geographically distributed node count, ensuring verification happens everywhere and resisting censorship. And it's just the predictable, relentless block production happening roughly every 10 minutes, adding to an immutable, growing ledger of truth, regardless of external factors like price swings or political events or anything else. These are the long-term drivers. They build the fundamental value and the resilience. The short-term price action is it's the market's constantly adjusting, often incredibly volatile attempt to price that underlying value, and it gets massively influenced by sentiment, speculation, and, as we saw, leverage.
But okay, let's play devil's advocate for a sec. For someone who just watched this rapid swing happen, maybe over what felt like just a few intense hours, seeing the price move significantly, knowing millions, maybe hundreds of millions in liquidations were involved, it felt like a really fundamental event was happening. So how do we reconcile that? How do we explain that a market move of this apparent magnitude can actually occur in such a short network time frame, just 124 blocks, if the underlying fundamentals shown on the dashboard didn't really change at all?
That's precisely the challenging data point that this whole synthesis helps clarify, I think. A price swing of this magnitude can happen over just 124 blocks because it's not driven by a fundamental change in the network's core mechanics or its verifiable properties during that very short time window. The network didn't suddenly speed up block production tenfold, its supply schedule didn't magically change, its security didn't fundamentally alter in those few hours.
It was driven purely by the market layer, not the protocol layer.
Exactly. It was driven entirely by the dynamics of the market. Human behavior, emotion, greed, fear. The use of leverage amplifying moves far, far beyond what simple buy-sell volume might suggest on its own. The specific arrangement of orders and liquidity sitting on exchanges at that exact moment, and critically, those cascade effects triggered around the large, concentrated liquidation clusters we saw building up on the heat map.
Right.
The price is just the market's constantly adjusting guess at Bitcoin's value, and that guess is heavily influenced by positioning, momentum, and short-term factors. The network metrics, on the other hand, those are verifiable facts about its immutable operation and its structure. They aren't guesses.
And that leads us directly to the critical concept of network resilience, which this whole event, this whole comparison so clearly demonstrates.
Yeah, this deep dive, this specific price event and the data surrounding it, it really serves as a powerful illustration of that resilience, doesn't it? Point again to the absolute stability of that massive 956.9 exahashes per second hash rate. Just solid.
Unwavering.
Point to the fact that the automatic difficulty adjustment is still projected for June 13th, anticipating just a modest meta 3% change based purely on past hash rate trends over weeks, not reacting to or being disrupted at all by the price volatility of the last few hours.
This is the proof. It shows that the core engine of Bitcoin, the network processing transactions, securing the ledger, it just continues to operate reliably, block after predictable block. 896,104 blocks and counting in our latest data snapshot. Completely unaffected by the price volatility and the speculative trading happening on the exchanges. The network didn't pause, it didn't slow down, its fundamental security didn't waver one iota during this market event. Its core function as a decentralized, immutable ledger and a secure store of value just continued robustly.
It really highlights the difference between trading on the network, or rather, trading about the network on exchanges, and the network itself. Two very different things.
Precisely. And it helps us understand why focusing solely on the minute-to-minute price chart on some exchange without ever looking at the underlying network data like we just did can give a fundamentally incomplete or maybe even a distorted view of what's truly happening with Bitcoin as a technology and as a potential monetary system.
Yeah, definitely food for thought. Hey, if you're finding this perspective valuable, understanding this distinction, definitely drop a like and share this deep dive. It's absolutely key to navigating the Bitcoin space beyond just, short-term trading.
Absolutely. The liquidation heat maps, they provide crucial insight into those potential pressure points that can cause swift moves. And seeing that potential value vulnerable jump from, $182 million up to $216 million, that clearly shows the scale of leverage in the market and how it shifts around. It matters.
But comparing that rapid, leverage-fueled event happening over a time frame corresponding to just 124 blocks.
With the steadfast stability and the totally predictable operation of the hash rate, the difficulty, the supply issuance, the node count, all of which just continued their relentless programmed work.
It provides essential, fundamental context. You need both pictures. The network continues its work, block by block, immutable and predictable, while the market reacts sometimes wildly to sentiment and positioning.
This deep dive truly underscores that duality that exists within the Bitcoin ecosystem. You have the market layer and the protocol layer.
Definitely. Hey, make sure you subscribe to the Snippet Labs YouTube channel to keep getting these deep dives where we use the data to look beyond just the headlines.
It's really about understanding which data points are signaling, short-term noise driven by market mechanics, and which ones represent the fundamental long-term reality of the protocol itself. Both are important, but they tell different stories.
And follow us on Twitter at Snippet Labs for more updates as the data unfolds in real time. Drop a like and share if you find this valuable.
Because this critical distinction between market activity and network reality is something every well-informed participant in the Bitcoin space really needs to grasp, I think.
Okay, time for some final thoughts then. Let's wrap this up.
Yeah, sounds good. The main takeaway here for you, the listener, kind of consolidating everything we've analyzed today, is really this. Short-term price volatility and these dramatic events like rapid swings amplified by significant liquidations, while they're absolutely impactful for traders focused on those immediate movements, and they generate a lot of excitement. They are fundamentally distinct from the slow, steady, and verifiable progress of the underlying Bitcoin protocol itself. There are just different layers of reality operating simultaneously.
Exactly. You've got the highly reactive, sometimes chaotic, volatile market layer reacting to news and leverage. And then you have the resilient, predictable, and fundamentally immutable network layer, just executing code.
Right. And given what we've seen today, the fact that a rapid swing generating significant liquidation pressure, now sitting at over $216 million in potential value on that heat map, occurred over the verifiable span of adding just 124 blocks to the Bitcoin blockchain, it really leaves us with a pretty profound question to consider, doesn't it?
What does this really tell us? Where should our focus be?
Yeah, how much weight and emphasis should actually be placed on this market noise? This short-term volatility that played out over barely 20 hours of network time. How much should we focus on that versus the undeniable block-by-block reality of the network's hash rate increasing massively over years, its automatic difficulty adjustments that maintain the almost clockwork-like block production, and its fixed, utterly predictable supply schedule that just continues precisely as programmed, completely independent of whatever the price is doing on any given day? What does this stark dichotomy between these rapid market moves and the steady, verifiable network progress teach us about where to focus our attention and maybe our understanding when we're trying to assess the true nature and the long-term value proposition of Bitcoin?
Markets move fast. Pinpoint your next profit window and seize the moment.
And definitely subscribe to the Snippet Labs YouTube channel if you want to keep exploring these kinds of questions with us, looking directly at the data.
And follow us on Twitter at Snippet Labs for those timely updates.
It's a crucial distinction to keep in mind. Thanks for tuning in.